this point, we are going to deal with problem relating to intercompany sale of fixed assets. The problem says that on January 2, 2018, PP Company purchased 70% of the shares of SS Company at book value. And on May 1, 2018, PP Company acquired a used machinery for $337,500 from SS Company that was carried in the latter's book at $270,000. Note that this is an upstream transaction. Additionally, the machinery has a remaining life of 6 years. On October 1, 2019, a downstream transaction occurred when SS Company purchased an equipment that was already 30% depreciated from PP Company for $570,000. The original cost of this equipment was $900,000 and had a remaining life of 5 years. The results of the operations for the year 2019 was also given as follows: net income of $945,000 for PP Company and $165,000 for SS Company. PP Company also paid dividends amounting to $345,000. Now we are asked to compute for the consolidated net income attributable to parents' shareholders' equity and to the non-controlling interest for the year 2019. So, let's start with the parents' net income from own operations amounting to $945,000. So this will go entirely to PP. Next is the subsidiaries' net income amounting to $165,000. 70% of which will be allocated to PP Company in the amount of $115,500 and the remaining 30% amounting to $49,500 will go to SS Company. Now, we will record the unrealized gains or losses on the intercompany sale of equipment for the year 2019. To identify if it's a gain or loss, we have to get the difference between the selling price and the book value of the equipment. First, let's identify the book value by multiplying the original cost of $900,000 by 30% to get the accumulated depreciation of $270,000. Accumulated depreciation will then be deducted to the original cost and it will give us the book value of equipment that is equal to $630,000. If we compare this to the selling price amounting to $570,000, it will result on unrealized loss of $60,000. Since this is a downstream transaction, the whole amount of $60,000 will go to PP Company alone. Now, we will also recognize a realized loss for the period. We obtain the amount by dividing $60,000 to the remaining life of 5 years, and since the sale happened in October, we will multiply this by 3/12, which will give us $3,000 for the realized loss. Now, there was also an intercompany sale of machinery for the year 2018, and we have to recognize the realized gain in the current year. We obtained that by deducting the selling price with the book value, and it will result to a gain amounting to $67,500. We will then multiply it with the remaining life of 6 years to get the realized gain during the year. And since this is an upstream transaction, we will allocate the 70% to PP Company in the amount of $7,875 and the remaining 30% to SS Company in the amount of $3,375. Adding everything, it will give us consolidated net income attributed to parents' shareholders' equity of $1,125,275 and $52,875 of the consolidated net income is attributed to the non-controlling interest. And that ends our discussion. Thank you for watching.